$100,000. For completely different strategies. Which one builds real wealth? You have $100,000. Not a fortune, but enough to change your financial future if you deploy it correctly. The problem? Most people either park it in a savings account earning 4%, or they rush into the first deal that looks good on Zillow. Neither is a strategy. Today, I'm breaking down 4 completely different ways to invest $100,000 in real estate in 2026, from hands-on to fully passive, from single property bets to diversified portfolios. Each strategy has different risk, different returns, and different time commitments. By the end, you'll know exactly which one fits your situation. Before we dive into strategies, let's set the baseline. $100,000 in a high-yield savings account earns roughly $4,000 to $5,000 per year. That's your opportunity cost. Any real estate strategy needs to beat that, or you're better off doing nothing. The S&P 500 has averaged about 10% annually over the last decade, so $10,000 per year is your benchmark for a passive investment. Real estate should either match that return with less volatility or significantly exceed it with active effort. One more thing, in 2026, mortgage rates sit between 6 and 7%. That changes the math dramatically compared to the 3% rates investors enjoyed in 2020 and 2021. Every strategy I'm about to show you accounts for today's rate environment, not yesterday's. Strategy 1. House hacking. This is the single most powerful strategy for a first-time investor with $100,000. Here's how it works. You buy a duplex, triplex, or fourplex, and you live in one unit while renting out the others. Because you're living in the property, you qualify for an owner-occupied mortgage. That means as little as 3.5% down with an FHA loan or 5% with a conventional loan. On a $300,000 triplex, your down payment is just $10,500 with FHA. That leaves you $89,500 in reserves for closing costs, repairs, and a cash cushion. Let's run the numbers on a real scenario. A $300,000 triplex in a market like Indianapolis, Indiana, or Cleveland, Ohio. 2 rental units at $950 each bring in $1,900 per month. Your mortgage payment at 6.5% on $289,500 is roughly $1,830. Property taxes, insurance, and maintenance add another $650 per month. Total expenses, $2,480. Rental income covers $1,900 of that. Your net housing cost? Just $580 per month, compared to the $1,500 you'd pay renting a comparable apartment. That's $920 per month in savings, $11,040 per year. Plus you're building equity with every mortgage payment. Effective return on your $100,000? Conservatively 15 to 20% when you factor in equity buildup, tax benefits, and the rent savings. The upside of house hacking is massive. You're leveraging $100,000 to control a $300,000 asset. Your tenants pay most of your mortgage, and you get owner-occupied tax benefits, including the ability to exclude up to $250,000 in capital gains when you sell. The downside? You're a landlord living next to your tenants. Midnight maintenance calls, screening tenants, dealing with turnover. It's not passive, it's a part-time job. And you need to be willing to live in a multi-family property for at least a year to satisfy the FHA occupancy requirement. House hacking is best for someone under 40 who's willing to trade comfort for accelerated wealth building. If you're okay living in a duplex for 12 to 24 months, this is the highest return strategy on this list. Strategy 2. Buying an out-of-state rental property. If you live in an expensive market like San Francisco, California, or New York, $100,000 won't buy you a parking spot. But in markets like Memphis, Tennessee, Birmingham, Alabama, or Kansas City, Missouri, that same $100,000 can buy a cash-flowing rental outright, or put 20% down on a $400,000 to $500,000 property. Let's look at the all-cash scenario first. You buy a $95,000 single-family home in Memphis, Tennessee. Market rent is $1,050 per month, $12,600 per year. Operating expenses, property taxes, insurance, property management at 10%, maintenance reserve, run about $4,800 per year. Net operating income, $7,800. That's a cap rate of 8.2% and a cash-on-cash return of 8.2%. Since you paid all cash. No mortgage means no leverage, but also no risk of negative cash flow. Every dollar of rent above expenses goes straight to your pocket. Now let's add leverage. Instead of buying one property outright, you put $50,000 down, 25%, on a $200,000 duplex in Birmingham, Alabama. Both units rent for $850 each, $1,700 per month total. Mortgage on $150,000 at 6.5% is $948 per month. Operating expenses including 10% property management, $680 per month. Total monthly cost, $1,628. Monthly cash flow, $72. That's only $864 per year in pure cash flow, a cash-on-cash return of just 1.7%. Disappointing? On the surface, yes, but you still have $50,000 left over for a second property. And here's what the 1.7% misses. Principal paydown of roughly $2,400 per year, plus appreciation averaging 3 to 4% annually on a $200,000 property. That's another $6,000 to $8,000. Total return including equity, closer to 12 to 15%. The catch? You're managing a property 800 miles away. That means hiring a property manager, which is already factored into our numbers, and trusting someone else to handle tenant issues, maintenance, and rent collection. Strategy 3. The BRRRR method. Buy, rehab, rent, refinance, repeat. This is the strategy that seasoned investors use to recycle their capital and build portfolios exponentially. Here's how it works with $100,000. You find a distressed property, foreclosure, estate sale, or a house that needs significant work. In a market like Cleveland, Ohio, or St. Louis, Missouri, you can find these for $50,000 to $70,000. Let's say you buy a distressed single-family home for $60,000 cash. You invest $30,000 in renovations, new kitchen, bathroom, flooring, paint, and systems. Total investment, $90,000. After rehab, the property appraises at $130,000. That's the after-repair value, or ARV. You rent it out for $1,200 per month. Then you refinance. A cash-out refinance at 75% of the ARV gives you a new mortgage of $97,500. After paying closing costs, you get roughly $90,000 back in your pocket. You've essentially recovered your entire initial investment, while still owning a $130,000 property that generates $1,200 per month in rent. The BRRRR method sounds like magic, and when it works, it is. You can theoretically repeat this cycle every 6 to 9 months, building a portfolio of rental properties while recycling the same $100,000 over and over. But here's the reality check. Renovation costs overrun by 20 to 30% more often than they come in under budget. Appraisals don't always hit your target ARV. And the refinance market in 2026 isn't as friendly as it was in 2020. Higher rates mean your new mortgage eats more of the rental income. Let's be honest about the numbers post-refinance. A $97,500 mortgage at 7% costs $649 per month. Add $400 in operating expenses. Total, $1,049. Monthly cash flow, $151 or $1,812 per year. That's a thin margin. One vacancy month wipes out 8 months of cash flow. BRRRR is powerful but requires skill. You need to accurately estimate rehab costs, manage contractors, understand local permit requirements, and time the refinance correctly. This is not a beginner strategy. It's best for investors who've already done at least 2 to 3 deals and have reliable contractor relationships. Strategy 4. Passive real estate investing. If you don't want to deal with tenants, toilets, or contractors, this is your path. You have three main options with $100,000. First, REITs. Real estate investment trusts trade on the stock market just like any other stock. You can buy shares of companies that own office buildings, apartments, warehouses, data centers, or cell towers. The average REIT returned 10.6% annually over the last 20 years, comparable to the S&P 500. You get quarterly dividends, instant liquidity, and zero management hassle. $100,000 in a diversified REIT portfolio might generate $4,000 to $5,000 in annual dividends, plus share price appreciation. Second, real estate crowdfunding platforms like Fundrise, CrowdStreet, or Realty Mogul. These let you invest in specific commercial deals, apartment buildings, industrial parks, medical offices, with minimums as low as $500 to $25,000. Expected returns range from 8 to 14% annually, but your money is typically locked up for 3 to 7 years. Third, real estate syndications. These are private group investments, usually requiring $50,000 to $100,000 minimum, where a sponsor buys and manages a large asset like a 200-unit apartment complex. Target returns are 15 to 20% IRR over a 5-year hold period. Higher returns, but you need to trust the sponsor and accept total illiquidity. The case for passive investing is simple: time. You spend 0 hours managing properties, screening tenants, or fixing leaky faucets. Your $100,000 works for you while you keep your day job, travel, or build other businesses. The diversification is also unmatched. With $100,000 in REITs, you can own a slice of thousands of properties across dozens of markets and property types. No single vacancy or bad tenant can wipe you out. But the trade-off is control. You can't force appreciation through renovations. You can't negotiate below market value. And with crowdfunding and syndications, you're trusting someone else's underwriting and management. Platform failures, like what happened with some crowdfunding sites during the 2023 commercial real estate downturn, can mean significant losses. My recommendation: split $100,000 across all three passive vehicles. $50,000 in REITs for liquidity and dividends. $30,000 across 2 to 3 crowdfunding deals for yield. And $20,000 in one syndication for upside. That gives you diversification, some liquidity, and exposure to institutional quality deals. So which strategy wins? That depends entirely on you. Let me break it down. If you're under 35 and willing to hustle, house hacking. You'll save $11,000 per year on housing costs alone while building equity in a $300,000 asset. Effective return, 15 to 20%. Best bang for your $100,000, period. If you want cash flow but don't want to live in the property, out-of-state rental. Buy in a cash flow market, hire a property manager, and earn 8 to 15% total returns. Requires some involvement, but far less than house hacking. If you're experienced and want to scale fast, BRRRR. Recycle your $100,000 into multiple properties, building a portfolio worth $400,000 or more within 2 to 3 years. But only if you have the skills and risk tolerance. If you want completely passive income, REITs, crowdfunding, and syndications. Earn 8 to 14% with zero time commitment. Lower ceiling than active strategies, but you get your weekends back. Here's the one thing that matters more than which strategy you pick: actually deploying the capital. The biggest mistake investors make with $100,000 isn't choosing the wrong strategy. It's analysis paralysis, spending 12 months researching and never pulling the trigger. Every month your $100,000 sits in a savings account. You're earning $400 instead of building real wealth. Pick one strategy, run the numbers on 3 specific deals, and make an offer within 30 days. The best investment you can make with $100,000 in 2026 is the one you actually execute. If this breakdown helped you think differently about investing $100,000, hit subscribe. We publish data-driven real estate analysis every week. Like this video if you learned something new about house hacking, BRRRR, or passive investing. And drop a comment. Which of these 4 strategies are you most likely to try in 2026? House hacking, out-of-state rentals, BRRRR, or passive REITs? Let us know below.